Today is April 18th, 2024. I am digital anchor Amy. Today news headlines are from the investment report of Volcano X Capital, a well-known investment institution. In-depth analysis of Bitcoin trends after this halving. As the fourth Bitcoin halving approaches, a pivotal moment for the cryptocurrency market is anticipated. This event, forecasted to occur between April 16th and 20th this year, will see Bitcoin's miner rewards cut in half from 6.25 BTC to 3.125 BTC per block. While historical halvings have been key indicators of potential market movements, Volcano X urges caution in directly extrapolating past patterns to predict future outcomes due to the limited sample size of three prior events. A new era in Bitcoin market dynamics. The introduction of spot Bitcoin ETFs in the United States has fundamentally altered the landscape of Bitcoin demand and supply. Within 2 months of their inception, these ETFs have seen billions of dollars in net inflows, marking a significant shift in market dynamics. This development has not only established new benchmarks for BTC demand, but also suggests that the upcoming halving could uniquely impact the market, diverging from previous cycles. Given these changes, understanding the current technical supply and demand situation becomes crucial for comprehending Bitcoin's potential post-halving. Supply constraints versus market capability. Although the reduction in new Bitcoin supply is a critical factor to consider, it represents just one among many influencing the cryptocurrency's value. Since early 2020, the available supply of Bitcoin for trading, i.e., the difference between circulating and non-circulating supply, has been on a decline, indicating a significant shift from previous cycles. However, recent data reveals an increase of 1.3 million in active BTC supply, Bitcoins that have moved within the last 3 months, since the beginning of Q4 2023, contrasted with only about 150,000 newly mined Bitcoins during the same period. Despite the market's increased capacity to absorb this supply, Volcano X advises against oversimplifying the complex interplay of market dynamics. Background and future outlook. Bitcoin undergoes a halving approximately every 4 years, or every 210,000 blocks mined, effectively reducing the miner reward and consequently, the daily issuance of new Bitcoins. Post-halving, the daily output of Bitcoin is expected to drop from approximately 900 to 450, adjusting the annual inflation rate from 1.8% to 0.9%. Such adjustments bring Bitcoin's monthly production to around 13,500 and the annual output to approximately 164,250, albeit these figures are subject to variations in actual hash rates. The halving mechanism embedded within Bitcoin's protocol will persist until all 21 million Bitcoins are mined, an event projected to occur around the year 2140. Volcano X perceives the underlying significance of the halving not merely in its immediate market impact, but more so in its ability to draw heightened media attention to Bitcoin's unique attributes. A fixed, deflationary supply schedule culminating in a hard cap on supply. This aspect of Bitcoin is often undervalued. For tangible commodities, such as minerals, it's theoretically possible to invest additional resources to mine and extract more resources, like gold or copper. Although there might be high barriers to entry, increased prices can incentivize the meeting of demand. However, due to Bitcoin's preset block rewards and difficulty adjustment mechanisms, its supply remains inelastic, i.e., unresponsive to price changes. Moreover, Bitcoin encapsulates a growth narrative. The utility of the Bitcoin network expands with the number of users on the network, directly influencing the token's value. This contrasts with precious metals like gold, which do not carry similar growth expectations. History does not repeat, but our analysis of the halving cycles concerning Bitcoin's performance is inherently limited due to only 3 prior occurrences. Consequently, research into the correlation between previous halvings and Bitcoin's price should be approached with caution. The small sample size makes it challenging to pattern these events solely based on historical analysis. Indeed, we believe that more halving cycles are necessary to draw robust conclusions about how Bitcoin typically reacts to halvings. Furthermore, correlation does not imply causation, and factors including market sentiment, adoption trends, and macroeconomic conditions can all contribute to price fluctuations. In fact, our previous assumption that Bitcoin's performance around halving events is contextually dependent could explain the significant variations in price trajectories across different cycles. As illustrated in Figure 1, Bitcoin's price remained relatively stable in the 60 days leading up to its first halving in November 2012, whereas, in the same timeframe preceding the second and third halvings in July 2016 and May 2020, Bitcoin's price rose by approximately 45% and 73%, respectively. This variability underscores the complex interplay of factors influencing Bitcoin's price, suggesting that each halving cycle unfolds within its unique contextual framework. In our analysis, the beneficial effects of the first halving did not become fully apparent until January 2013, when the impacts of the Federal Reserve's quantitative easing program, QE3, intersected with concerns over the US debt ceiling crisis. Thus, we posit that increased media coverage of the halving could enhance public awareness of Bitcoin as an alternative store of value amid widespread inflationary fears. In contrast, in 2016, Brexit may have triggered financial anxieties in the UK and Europe, potentially catalyzing Bitcoin buying behavior. This trend continued into the ICO craze of 2017. At the onset of 2020, unprecedented stimulus measures by central banks and governments worldwide in response to the COVID-19 pandemic significantly boosted Bitcoin liquidity once again. It is also crucial to note that analyses of historical performance can vary greatly depending on the observation period relative to the halving event. Price return metrics can differ whether the analysis looks at periods starting and ending 30, 60, 90, or 120 days from the halving date. Thus, employing different windows can influence conclusions drawn from past price performances. For our purposes, we use a 60-day time frame as it helps to filter out short-term noise while remaining close enough to the halving that other market factors may begin to dominate price drivers in the longer term. ETFs, the key to success in the beginning. The introduction of spot Bitcoin ETFs in the United States is reshaping Bitcoin's market dynamics by establishing new benchmarks for Bitcoin demand. In previous cycles, liquidity was a key barrier to upward price momentum because major market participants, including but not limited to Bitcoin miners, would drive sell-offs in attempts to exit long positions. The availability of spot Bitcoin ETFs has fundamentally changed this dynamic by providing a more structured and accessible means for institutional and retail investors to engage with Bitcoin. By acting as a bridge between traditional finance and the cryptocurrency world, these ETFs mitigate some of the liquidity issues previously seen and broaden the investor base. This diversification of market participation not only enhances liquidity but also potentially stabilizes price volatility associated with large sell-offs. Furthermore, the institutional backing implied by ETF offerings confers a degree of legitimacy upon Bitcoin, encouraging further adoption. In summary, the evolving context, marked by macroeconomic factors, emergent investment vehicles like ETFs, and shifts in market sentiment, plays a crucial role in shaping Bitcoin's journey post-halving. While history provides valuable insights, the unique confluence of conditions surrounding each halving event means that future outcomes cannot be predicted purely based on past trends. Stakeholders should therefore approach the market with a blend of historical knowledge and attentiveness to current developments. Today, the inflows into ETFs are poised to absorb a significant portion of the supply in a gradual and sustained manner. Currently, the daily average BTC spot trading volume from ETFs is estimated to be between $4 to $5 billion, accounting for 15 to 20% of the total global centralized exchange volume. This level of liquidity is sufficient for institutions to execute trades within this domain comfortably. In the long term, such steady demand could have a positive impact on Bitcoin's price by fostering a more balanced market with reduced volatility from concentrated sell-offs. In the initial 2 months following their launch, spot Bitcoin ETFs in the United States have attracted $9.6 billion in net inflows, with total assets under management reaching $55 billion. This development indicates that during this period, the cumulative net growth of BTC held by these ETFs, 180,000 coins, was nearly 3 times higher than the supply of 55,000 new Bitcoins produced by miners, as shown in Figure 3. According to Bloomberg, looking at all global spot Bitcoin ETFs combined, These regulated investment tools currently hold about 1.1 million bitcoins, accounting for 5.8% of the total circulating supply. In the medium term, we may see ETFs maintain or even increase their current levels of liquidity as major broker-dealers have yet to start offering these products to clients. With over $6 trillion still sitting in US money market funds and anticipated interest rate cuts on the horizon, it is our belief that a substantial amount of idle capital could flow into this asset class within the year. It's worth mentioning that potential concerns around the centralization of Bitcoin holdings due to ETFs do not pose a stability risk to the network, as merely owning Bitcoins does not impact the decentralized network or allow control over its nodes. Moreover, financial institutions are currently unable to offer derivatives based on these ETFs as underlying assets. The availability of such derivatives could alter the market structure among large participants. However, regulatory approval for these derivatives is likely several months away, at a conservative estimate. This development underscores the significant shift towards institutional involvement in the cryptocurrency space, driven in part by the vehicle of ETFs. As the landscape evolves, the integration of traditional financial products with digital assets like Bitcoin not only broadens accessibility but also introduces new dynamics in terms of market liquidity, investor base expansion, and potentially the mitigation of price volatility. The ongoing adaptation of regulatory frameworks to accommodate such innovations will be crucial in shaping the future trajectory of Bitcoin and its integration into the broader financial ecosystem. Assuming a hypothetical scenario where the influx of new capital into US-based ETFs slows from February's pace of $6 billion to a steady state of $1 billion in net inflows per month, a rudimentary mental model would suggest that, relative to the approximate 13,500 BTC mined each month post-halving, Bitcoin's average price should be around $74,000. However, a significant limitation of this model is the assumption that miners are the sole source of Bitcoin supply on the market. In reality, the imbalance between newly mined Bitcoins and ETF inflows represents just a fraction of the longer-term cyclical supply trend. Damned lies and statistics. One method to measure the available supply of Bitcoin for trading is by subtracting 1. The current circulating supply, 19.65 million BTC, from 2. The non-liquid supply, which comprises Bitcoins that are essentially out of circulation due to lost wallets, long-term holding, or otherwise being locked away. Based on data from Glassnode, which classifies non-liquid supply based on cumulative inflow versus outflow over an entity's lifespan, the level of available Bitcoin supply has shown a downtrend over the past 4 years, decreasing from a peak of 5.3 million BTC at the start of 2020 to the current 4.6 million. This represents a significant shift compared to the steady increase in available supply observed during the period surrounding the first 3 halvings, as illustrated in Figure 5. This decrease in liquid supply amidst growing institutional interest, particularly through ETFs, underscores a fundamental shift towards a more illiquid market state. As non-liquid supply increases, whether through long-term holding strategies, loss of access, or institutional acquisition, Bitcoin's available supply contracts, potentially exerting upward pressure on prices in the face of steady or increasing demand. Such dynamics highlight the complex interplay between supply and demand factors influencing Bitcoin's price. While miners indeed add new Bitcoins to the ecosystem, the broader context includes changes in liquid versus non-liquid supply, institutional adoption rates, and macroeconomic trends. All these factors contribute to shaping the cryptocurrency's market environment, further complicating simplistic models of price prediction based on supply-side considerations alone. At first glance, the decreasing availability of Bitcoin for trading appears to be one of the primary technical supports for Bitcoin's performance due to new institutional demand from ETFs. However, considering the impending reduction in new Bitcoins entering circulation, these supply and demand dynamics suggest a potential short-term market tightening. That said, we believe this framework does not fully capture the complexity of Bitcoin market liquidity dynamics, especially since non-liquid supply does not equate to static supply. Investors should not overlook several key factors that could influence selling pressure. Not all Bitcoins accounted for in the liquidity gap are trapped. Long-term holders holding Bitcoin for more than 155 days, accounting for 83.5% of holdings, may be less economically sensitive to their positions compared to short-term holders. However, we anticipate some individuals within this group might still choose to realize profits as prices rise. Some holders may not intend to sell in the near future, but can still provide liquidity by using their Bitcoin as collateral. This also impacts the non-liquid characteristics of these Bitcoins to some extent. Miners might sell their Bitcoin reserves, currently totaling 1.8 million BTC among public and private miners, to expand their operations or cover other costs. The approximately 3 million BTC held by short-term holders is not insignificant. Speculators might still exit for profit amid price fluctuations. Ignoring these significant sources of supply overly simplifies the argument that inevitable scarcity results from reduced mining rewards and steady ETF demand. In our view, a more comprehensive assessment is needed to determine the true supply and demand dynamics behind the upcoming halving event. Active supply and flow. Even with Bitcoin being incorporated into ETFs, the growth rate of active circulating supply, defined as Bitcoins that have been transferred in the last 3 months, has significantly outpaced the cumulative inflows to ETFs, as shown in Figure 6. Since Q4 2023, the active BTC supply has increased by 1.3 million, whereas newly mined Bitcoins only account for about 150,000. This increase in active supply suggests that despite the absorption of Bitcoins into ETFs and other long-term holding strategies, a substantial amount of Bitcoin remains liquid and part of active trading cycles. The dynamic nature of Bitcoin's liquidity underscores the need for a nuanced understanding of both the market supply side and how various factors, ranging from miner behavior to investor sentiment, contribute to the overall liquidity landscape. Moreover, the evolving context of Bitcoin's liquidity, influenced by macroeconomic factors, technological advancements, and regulatory changes, will continue to shape its market dynamics. As such, stakeholders must remain vigilant, adapting their strategies in response to both anticipated and unforeseen shifts within this complex ecosystem. A portion of the active supply indeed comes from miners themselves, who might be selling reserves to capitalize on price trends and to establish liquidity in light of reduced income, an aspect we discussed more thoroughly in our report Bitcoin Halving and Miner Economics, published on January 30th. This practice by miners mirrors their actions in previous cycles. However, Glassnode reports indicate that between October 1st, 2023 and March 11th, 2024, miners' wallet net balances decreased by only 20,471 Bitcoins, suggesting that the newly active Bitcoin supply primarily originates from sources other than miners. In previous cycles, changes in active supply outpaced the growth rate of newly mined Bitcoins by more than 5 times. During the 2017 and 2021 cycles, the active supply nearly doubled, increasing by 3.2 million, from a trough to 6.1 million, over 11 months, and 2.3 million, from 3.1 million to 5.4 million, over 7 months, respectively. In contrast, the amount of Bitcoin mined during these same periods was approximately 600,000 and 200,000, respectively. Meanwhile, in this cycle, the non-active supply of Bitcoin, defined as Bitcoins unmoved for over a year, has also seen a decline for 3 consecutive months, which could signify long-term holders beginning to sell, as shown in Figure 7. Under normal circumstances, this would be interpreted as a mid-cycle signal. In the 2017 and 2021 cycles, the time span from when non-active supply peaked to when the cycle's highest price was reached was about 12 and 13 months, respectively. It appears that the peak of non-active Bitcoins in the current cycle was reached in December 2023. This potential increase in market activity from both long-term holders and miners, coupled with the dynamic influx of institutional demand through ETFs, underscores the multifaceted nature of Bitcoin's supply and demand equation. The interplay between active and non-active supply provides valuable insights into market sentiment and potential future price movements. Given these observations, stakeholders in the Bitcoin ecosystem should closely monitor these supply dynamics, as they can offer early signals about shifts in market direction. Additionally, understanding the behavior of different market participants, including miners, long-term holders, and institutional investors, can help in making informed decisions in this complex and evolving landscape. conclusion, as we at Volcano X Fund Company analyze the evolving landscape of Bitcoin and its integration into mainstream financial instruments, it's apparent that this cycle offers unique dynamics compared to previous ones. The introduction and sustained daily net inflows into US spot Bitcoin ETFs represent a substantial driving force, signaling a notable shift towards broader institutional acceptance and investment in digital assets. Considering the imminent reduction in new Bitcoin supply due to the halving event, we're observing a tightening in market dynamics that could potentially alter traditional supply and demand balances. While some may speculate about entering a supply crunch, our analysis suggests a more nuanced future where demand and selling pressure will need to find a new equilibrium. The role of spot Bitcoin ETFs cannot be overstated. As a new asset class, these ETFs have bridged the gap between conventional investment strategies and the digital asset space, marking a pivotal moment in the journey toward Bitcoin's mainstream adoption. This development not only enhances the liquidity and stability of Bitcoin as an investable asset, but also opens up avenues for traditional investors to participate in the cryptocurrency market within a regulated framework. Furthermore, our examination reveals that the narrative surrounding Bitcoin's liquidity and supply dynamics is far more complex than it might appear at first glance. The interaction between dormant supply becoming active, miners' behavior, and the impact of derivatives amplifying spot market activities underscores the multifaceted nature of Bitcoin's market ecosystem. In light of these insights, Volcano X maintains a cautiously optimistic outlook on Bitcoin. We assert that while immediate hurdles related to supply and demand exist, the foundational shifts occurring primarily through the institutionalization of Bitcoin via ETFs portend well for its long-term trajectory. Thus, we believe that the current trends suggest just the beginning of what could be a prolonged bull market phase, requiring ongoing adjustments in market dynamics to foster a sustainable balance between supply and demand. In conclusion, as part of our commitment to providing our clients and partners with forward-looking analysis, Volcano X will continue to monitor these developments closely. Our aim is to navigate these changes strategically, ensuring that we are well-positioned to capitalize on the opportunities that arise as Bitcoin further cements its status in the global financial landscape. Okay, today's blockchain news headlines are shared here. Thanks again Volcano X Capital for the great report. I am a digital human made 100% by artificial intelligence AI. If you like my show, please like, subscribe, and forward my videos to your friends. AIGPU is AI technology that truly everyone can use. See you tomorrow.